Kenyan bankers back government sale of Safaricom shares as a strategy to curtail borrowing. The Association of Bankers of Kenya, ABK, has publicly supported the government's move to sell a portion of its stake in Safaricom plc, describing the divestiture as a viable alternative to further borrowing and taxation in addressing Kenya's mounting fiscal pressures. A strategic revenue mobilization move. The Treasury's plan involves the sale of a 15% stake in Safaricom, one of Kenya's most profitable and strategically important companies, in a block deal with Vodacom Kenya Limited. Under the proposed transaction, the government expects to raise about 204.3 billion Kenyan shillings, representing roughly a 19% premium over the company's listed share price. Bankers argue that this move would inject substantial non-debt capital into the economy without increasing taxes or resorting to expensive borrowings. In a context where the cost of servicing Kenya's public debt and fiscal deficits has been rising significantly, the sale has been presented as a pragmatic way to fund national priorities. Why bankers see it as preferable to borrowing. Supporters from the banking sector see several potential advantages in monetizing state shareholdings rather than expanding debt portfolios. Avoiding higher taxes. With public tolerance for these tax measures, way to raise funds. Reducing reliance on expensive debt. Kenya has faced rising borrowing costs, with significant portions of revenue now directed toward interest payments rather than productive public expenditure. Mobilizing large-scale capital. The sale of a major listed asset like Safaricom delivers a one-off cash infusion that could seed long-term investment vehicles such as the planned National Infrastructure Fund and a sovereign wealth fund. Government rationale and use of proceeds. The Treasury, led by Cabinet Secretary John Body, has defended the transaction as a necessary shift in how Kenya funds major infrastructure and development projects. In Parliament, Body explained that proceeds would be ring-fenced for commercially viable priority projects in energy, water, transport, and digital infrastructure, rather than used to close recurrent budget gaps. Officials also emphasized that the sale would be structured to protect national interests, including commitments from the buyer to maintain Kenyan leadership in Safaricom's board and to avoid job losses related to the transaction for a specified period. Broader debate and opposition concerns. While bankers have backed the sale as a sensible revenue strategy, the plan has drawn criticism from some economists, lawmakers, and civil society voices. Critics argue that the valuation might not maximize Kenya's value from the asset, with concerns that pricing based on prevailing market rates could undervalue Safaricom's long-term prospects. Monetizing future dividend streams in exchange for upfront payment might sacrifice reliable long-term revenue for short-term cash. Reduced state ownership in a strategic telecommunications and financial ecosystem player could weaken national control and influence over critical infrastructure. In parliamentary engagements, some MPs have pressed the Treasury for greater transparency and safeguards around how the funds will be managed to ensure they are used as intended, not diverted into recurrent expenditure. Fiscal context. Why this matters now. Kenya's fiscal dynamics have made conventional borrowing increasingly costly. Latest reports show that debt servicing has risen sharply, consuming large portions of government revenue, forcing policymakers to explore alternative revenue options beyond taxes and loans. Against this backdrop, the sale of state assets like Safaricom has become a centerpiece of debates on how best to balance economic growth, debt sustainability, and public investment. Looking ahead. The public participation phase in Parliament's review process has concluded, drawing thousands of submissions from Kenyans, many opposing the deal. The outcome and legislative ratification will shape how, and whether, this landmark asset sale moves forward. As the debate unfolds, the backing from the banking sector adds weight to calls for innovative approaches to fiscal management, even as questions linger about the long-term trade-offs of selling stakes in highly profitable national enterprises.